Word on Wealth with Gary Quackenbush is sponsored by the Word on Wealth Radio Network. This is the Word on Wealth with Gary Quackenbush of GQ Law. Gary is a San Diego financial solutions attorney protecting people like you. The Word on Wealth team of financial experts is here to answer your questions and help preserve your family's financial future. Now, here's Gary.
You're live. Happy Monday, everybody. This is Gary Quackenbush, your host of the Word on Wealth. Today, we're going to be having, we're going to talk about taxes after a while. That's coming up next. We're going to have attorney Rich Mathurin from GQ Law coming on, and that's going to be at the half hour, and talk about tax problem solving. So if you know somebody that has a tax situation they're trying to deal with, if the IRS or the state of California is after them, or if they haven't filed in a while, those are the kind of things we're going to be talking about, and that's coming up later in the show. Have you ever tried to figure out where a lost beneficiary is? Now, that happens sometimes where grandpa passes away and he has listed in his estate plan, specifically, I'm thinking of a case where grandpa listed several people that we could not figure out who they were. So what the successor trustee wanted to do was ignore the person because it's listed in the will, didn't know what that was all about, didn't know who the person was. And so the temptation is, well, are they going to know what went on? What if we can't find them? We don't know who this person is. We have, we really don't know. What do you do? It is the legal obligation of that successor trustee to make reasonable efforts, which are pretty extensive, reasonable efforts to determine who that person is. So what happened is the successor trustee then had to talk to different family members to ask who this person was. There are a bunch of people named in the trust. So they all got notification of that the person passed away and that they had been named in a living trust. That one person was too difficult to find. So in talking to all the other beneficiaries, we basically had a powwow in one way or another and said, who is this person? Does anybody know who they were? And ultimately it was determined that it was like this friend that he had watched over and took care of. And we ended up figuring out more about the person. We hired a private investigator. Some private investigators, it's crazy what they can find. They need a name. If they had any part of a social security number, that works really fantastic. But even approximate date of birth, then they can start digging, and not just the stuff that we can find on the internet where you pay, $11 to do a background check. It's not that. You can get private investigators that can get really seriously into figuring out where people are. Well, that was a success story. We ended up finding that beneficiary, giving him notification of the distribution process. Because the person is listed in the trust, you can't ignore them unless you can prove that they've died. Okay. And what the court, because everything has to be by a court standard. So you got to think in terms of, well, what if I was in front of a judge? What would I have to show the judge to have the judge say, oh, okay, you don't have to give that person any money? And the answer is you have to prove that that person has died. And you have to show where it says in the trust or the will or whatever document you're going by, usually a trust. You're trying to show how in the trust it says if this person predeceases, dies before the creator of the trust, then they get excluded. But sometimes it would go to that person's children. And that was the problem that we were fighting with, is we're trying to figure out, what did the trust say? It wasn't super well written, but we ultimately came to the conclusion that there was not enough writing in the trust. There wasn't enough description that would force us to try to find now this person that had passed away, to try to find his kids or any heirs. So it just went away. But we had to prove death. We had another one that was more difficult, where you have a situation where you might have somebody that is homeless. And the problem with like a sister that's homeless is if you figure out where they are, if they're in a homeless shelter, by law, the homeless shelter can't acknowledge that they're there, which is very difficult. Because if you talk to the homeless shelter and say, well, we think that this person lives at this shelter and we think that's great. And thank you for taking care of them. And thank you for your contribution to society. But we think this person is there and we need to contact them. And they will just tell you, we can't, our obligation, these people are remaining anonymous and we can't tell you who's here. So we've had some issues with that a couple of times. And it's a little frustrating because it's, we're trying to go, we want to give this person money. He's inheriting money. Can you give him a letter for us? We can't even acknowledge the person's here. So there's some methods that we've used to try to get around that. We had one situation where a lady, this was quite a while ago. This is the first time I thought this was pretty cool, is it was a trust, and the trust said that I give my ring to, and it was like some person, Margaret, Margaret, and my good friend Margaret. So we ended up talking to the family members, and they said, Margaret hasn't been his friend for like so many years. We've never even heard of her for like 15 years. She kind of like fell away from the family, and she's not a member of the family. She's not related by blood. It was just kind of this person, this friend that we had. Well, we ended up trying to figure out where she worked, trying to figure out anything we could. And we really got blanks. Hired a private investigator, and he ended up finding her by, let's see. So he found her because he knew, somebody knew, hey, didn't she work down at the Ramada Inn? And so he goes to the, and these are all, it wasn't really the Ramada, but we went to the Ramada Inn and said, does so-and-so work here? No. Do you know where she went? Oh yeah, she was here for a while, but this was 5 years ago. She went back east somewhere. Any idea where? Oh, I don't know. She said she was going to go, whatever. So he ended up tracking her down, found her, and let us communicate with her because we got the address. We're trying to give her notification that she gets this ring. So when I talked to her, I said, this person passed away, and she was saying, I kind of think I know who that is. I said, well, do you know? And here's his family, here's these other people. And so we identified positively, yes, it was her. And then she said, what do I get? And I explained to her, she gets a ring. She said, why do I want a ring? I mean, that was like, that's wild. I said, do you want us to send you the ring?
2 minutes.
Or the money? And what did she say? She said, send me the money. So we found a jeweler, gave us an appraisal, gave us $1,500 for the ring, and we shipped it off to her. And that was, see, the thing is, that's the successor trustee's job, is they have to do that. They can't just say, nobody knows who Catherine is, so let's distribute her share. Because what if Catherine comes by later and goes, hey, wait a minute, I thought I was listed in this trust. So as a successor trustee, you've got to do what the thing says. This is part of the reason where I like people to get their trusts amended. And if you want help with this, my number is 855-500-TRUST. So get your trust amended and look back through it. And if you have done things in your trust, like given specific things, I give my 280Z to my son-in-law, or I give my, whatever. If you have specifics, I don't like to put specifics in a trust because it gets a little tricky in that if that gift doesn't exist, does that mean we're supposed to replace it with cash? Or what if it went to somebody else, or, whatever. But there's a lot of things. So look back through your a trust or will and make sure it says what you want. And you don't have to understand all the legal terms. You just go through it. And if you look at it, it goes, oh, there it is, distribution. Give everything to my kids equally. Okay, fine. If it says, give my Mustang to my, my best friend, John, and he's not your best friend, we need to amend. So when you're looking at your trust to see if it's updated, I know you don't know specifically what the law changes were. If it's 3 to 5 years, you're probably okay with the law. If you're any older than that, we really need to take a look and see if it complies with current law. Happy to do that for listeners. 855-500-TRUST. We can take care and make sure your trust says what you want it to say. If you do not have a trust, now's the time before the holidays. 855-500-TRUST. Let's get your estate plan done. I'm happy to talk to you about that and get that all set up. So check it, see if it's what you want. If it's not, let's get it fixed. Coming up next, we're going to talk about a case of the week. Very interesting with the successor trustee issue here on The Word on Wealth.
You don't need to know everything. You just need to know where to find answers you can trust when you need them. Welcome to the Word on Wealth with Gary Quackenbush. We're here to help you build, protect, and transfer everything you've worked hard for with expert estate planning, trust administration, inheritance, and probate. Call Gary and the team at gqlaw.com. 855-500-TRUST.
You're saving and investing for the future, and that's good. Have you ever stopped to think, where does my money actually go? This is Faith-Based Investing with Anthony Wright.
Most Christian families don't understand this one thing. The money that you're saving for retirement helps fund the abortion industry as well as other liberal anti-family causes. It's the sad, dirty little secret of American investing world. And here's the good news, though. You probably also didn't know that just a few minutes of your time and we'll screen and clean your investments for you. There's no cost, no obligation. Learn the truth about your own investment mix. Then the choice is yours. Remember, the word says when God's money is in the hands of the righteous, the people rejoice. Well, we also are fiduciary investment advisor representatives. That means that our firm makes a pledge to always act in your best interest. Go to BibleSafeInvesting.com. Download a free copy of my book, Faith-Based Investing, or call me at 931-RETIRED. And please don't forget, listen to Faith-Based Investing this weekend right here on Family Talk.
So Gary, we've talked a long time about estate administration. So what is that and why is it important?
Estate administration is the distribution part of estate planning. So when someone passes away and they leave money to beneficiaries, the property has to be administered. So it's like taking it from the decedent to the survivor. That's called the estate administration process. So usually you're going to have a successor trustee that's named in the trust. They'll have no idea what they're doing because they've never done it before. So then they call on GQ Law and we walk them step by step on how to be a successful and good successor trustee. We also do the required notifications. We notify the Department of Health Services and all the legal requirements so that they can have the estate administration done properly. We help successor trustees be successful.
Call or click to request your free consultation. gqlaw.com. 855-500-TRUST. gqlaw.com. When Brad Stoner started his painting company 30
Tell a friend about this broadcast outreach, The Word on Wealth, with Gary Quackenbush of GQ Law. Call or click to request your free initial consultation or to talk with a member of the team. Call Gary at 855-500-TRUST. GQ Law.
Go ahead.
Welcome to the Word on Wealth. This is Gary Quackenbush. I am here every weekday, Monday through Friday, same time, same station. I also rebroadcast this on a podcast, which you can find at, you can find it in the iTunes library, Spotify, Google Podcasts, any major podcast platform. And it is just called The Word on Wealth, just like this radio show. So if you want to re-listen, go to The Word on Wealth. You can also go to YouTube and look for The Word on Wealth, and you'll be able to find that. All those are housed in my channel, which is the GQ Law channel. So you can go to Word on Wealth, find shows. And why would you want to watch a radio show? It's kind of like watching paint dry. I don't know, but we do it because that's one of the mediums that we like, and at least you can see us doing this radio show and producing it. So I am the producer and the host of this show. And is that right? No, Noah is the producer of the show. Geez, sorry, Noah. So Noah's the guy that's in the background that does everything and makes sure that everything is right, on time, commercials are running appropriately and that I'm saying the things I'm supposed to rather than going off track. So Noah steers me. But you don't know that because he's talking in my left ear and you can't hear that. It's a little secret thing we have. Now I've let out all the secrets. Okay, I got to stop. But we talked about
Gary, stop letting out the secrets.
We talked about if you have a beneficiary that you can't find, can you ignore them? The answer is no. The answer is heck no. The answer is don't do that. It's illegal. You as a successor trustee, your goal, the only goal is to get your job done and be out from that job. That means you got to do it right according to the law. If you don't know the law, well, then you're like probably 99% of all successor trustees. You don't know the law. Does that mean you don't have to obey the law? Oh, heck no. That means you're going to have somebody, if you mess up, that means you're going to have somebody, some attorney that's going to go and enforce it and make sure that you are doing it right. And you're going to have to do it right. So do it right. Don't get in trouble. If you are struggling to be a successor trustee, that's another one of those things that we really enjoy doing is helping you out. We can do that. Give me a call. All right. 855-500-TRUST. I wanted to talk about, we usually do these, this is a case. This is like an actual case. I've changed it a little bit so you don't recognize it, but, this is sad. It's kind of really, it happened a while ago, but it's really apropos to like right now. 4 adult children. Okay. The son, so there's 1 son and 3 sisters. The son is the successor trustee. He makes good money. He's a big deal. At least he thinks he is. And he decides that he doesn't want to sell mom's house without it being upgraded. It's embarrassing. Somebody walks in your mom's house and she's maybe been, collected a lot of junk. The carpet's worn out. The house isn't like, all upgraded because you got these 40-year-old cabinets and countertops that are all, with black grout and white tile, and God, how embarrassing, right? Well, what this guy did is he decided that he would do these upgrades. And so he hired a friend that was a contractor to come in, and he wanted to be able to help, so the brother then would work on it on weekends, and things went on and on and on and on. And $100,000 later in upgrades and a year and a half, what happened is the market it dropped. So the market is going up. Mom and dad are both gone. The house value is going up and up and up. He wants to make the house value even better, probably because some real estate friend of his said, hey, if you put in a new bathroom, if you put in all new bathrooms and a new kitchen and this new super good tile and you repaint, in fact, you should re-stucco and you should re-roof this thing. This is going to be a cherry and you could sell that property. Well, that's what he did. And it took a year and a half and the market tanked while that was happening. So he put $100,000 in upgrades. Where did that money come from? You're right. It came from the trust. So the sisters and the brothers' money sitting there in trust, waiting to be distributed. He sunk $100,000 into the house. He sold the house a year and a half later, and the value had dropped way over $100,000. So what was the problem? Well, the problem is because he was waiting and wasn't even trying to sell it, he was trying to do all these upgrades and stuff. It took him a year and a half. And in the meantime, the house dropped in value of $100,000. Pretty easy to prove. You can look at records that'll show you house values at certain dates, dropped in value $100,000. Plus, he had just spent $100,000 of trust money. So what did his actions cost the trust? If we did a really rough calculation and said, 20 grand, 20 grand you could have spent on the house and done some, painting and some sprucing up and make it smell good and put in some really, nice looking but cheap carpet that's going to be torn out anyway. So we'll give you that. So we'll give you 20 grand for the remodel, for the upgrades. So now I got $80,000 in upgrades that shouldn't have been done. And I got $100,000 decreased value. What is that going to cost him? Well, if you can just show, and it's not that difficult, show that it was the trustees' failure. They just waited too long and they weren't doing anything in the meantime. The sisters were they're out for this one and saying, we want $180,000 because that's what it was reduced by. Value drop, spent a bunch of money. It was trust money. They weren't happy that he was doing it. And it went on and on and on and on. So what ultimately happened is we had to settle it. But what would have happened if we went all the way to trial, besides spending a huge amount of money getting there, is that $180,000 reduction. Obviously, it was, 25% of it was the brother's problem because he's a 25% heir. So we ended up resolving it, trying to keep the pieces together in the family, but they were really mad. $180,000 reduction divided by 4. That's real money. It's $45,000 each. That's a lot of money to absorb. And they basically wanted him to cover a lot more than that. So he had to pay it out of his share because it was a breach of duty. That's what we're able to show. It's a breach of his fiduciary duty to act reasonably. And it wasn't reasonable that he took that long. Now, if he had put it on the market and the market went up and down and, if something fell out of escrow and you tried again, you fell out of escrow and you have professionals that were doing it. Like if it were a professional real estate agent trying to sell that house and this is what's going on, or if you, if there's some justification by a professional, not by a family member, not by somebody emotionally responding and saying, oh my gosh, my mom's house is really ugly. I can't let anybody inside because they'll know that my mom, in her later years didn't take care of her house. That happens all the time, guys. But it wasn't good enough. That wasn't a good excuse. And so he wasted money. So he had to pay, had to come out of his share. And the sisters were, they're okay, happy with it. And he was unhappy, but he got his, after that, he was able to finish his trustee duties and get released from his obligations. But it was really, there's a lot of problems in there, a lot of emotions. Who is at fault when there's a loss to the estate? It's going to be the successor trustee. It's their job to preserve the assets of the estate. And if they don't do anything, if they don't do what they need to and act reasonably, then it's going to come back to the, it's going to cost the successor trustee. The successor trustee's job is to reduce risk, reduce loss the best they can. The successor trustee, then he, in this case, would have to make the trust whole and pay it back out of his share. So if his were $45,000, then, his share of the loss is $45,000. So he's basically going to have to pay his sisters back to $135,000 out of his own share. So that's what would have happened. Reduce his share by $135,000 and then pay everything out to the kids. So, it's typical that when there's a trust, I mean, don't be thinking that, okay, my mom died 2 months ago. My brother was really good and he sent me the copy of the trust, but now I want my money. It's going to take 6 months or so before you get any money because there's some rules that have to be complied with. Notification to creditors. The Department of Health Services wants to talk to them. There's these creditor claim periods where you can have a creditor that's unknown or known, make a creditor claim. Those things all have to transpire and pass. So there's some timelines that make trust administration typically slow. A year is not unheard of. 2 years, you're starting to get way too long, but a year, anywhere between 7 or 8 months to a year and a half, that's pretty typical. So that's what we should expect. If it's much longer than that and you don't know what's going on, the key is if you don't know what's going on, that's a problem. Okay. If you don't know what's going on, that's a problem. You need to figure that out. I can help you with that. If you're a beneficiary, if you're a successor trustee and you don't know your job quite right, you're trying to figure out, what am I doing next? Am I doing this right? Am I going to be in trouble? Just call me. I'm happy to walk you through it. 855-500-TRUST. Next topic is putting things in a trust. Now, if you do a living trust, you can draft it, get it drafted, hopefully by a competent attorney that knows what the heck they're doing, that can explain to you what's going on and all that stuff. So let's say you got it drafted and it's beautiful. It's even in a beautiful binder and you're just like, oh my gosh, this is so amazing. I'm going to take it. I'm going to put it under my pillow tonight because I'm so happy that I got my living trust. But if there's nothing in it, it's not even valid. So hopefully your estate planner will have transferred your house to the trust by doing either a quitclaim deed or a grant deed that transfers the house from you as an individual to you as the trustee of your trust, because that is what changes the title of the house into the trust. So when we say it's in the trust, it's not in anything. There's not like a tarp over it, a speed bubble or something like that. It's in the trust because the title is now in the hands of the successor trustee who can manage it. Initially, it's the trustee, right? The creator, the trustee of the whole thing. And then after they become incapacitated or die, then it becomes the successor trustee's job to administer the estate. All right. So you got that where the successor trustee then is now technically entitled with that house. So the house has to be in there. And if that's the case, well, at least your trust has something.
Two.
What about your cars? Big fan. Did not used to be a big fan of this, but I'm a huge fan of this now. If you have a car, put it in your trust. So go through the hassle, whatever it takes, to go to the DMV and get them to transfer that car title into the name of the trust. It makes all the difference in the world when you pass away, because the successor trustee can get going. If you don't put it in the trust, we can fix that later, but there's at least a 40-day waiting period. So you're talking about a month and a half to 2 months before you can sell it. And if you have a car that you don't want to keep because the person passed away and you got to wait 2 months to sell it, that's awful. There's insurance, there's storage, there's all that stuff. So put your cars in your estate plan, like put them in your trust. Life insurance. I am a huge fan of life insurance going directly to the living trust, because your survivor, if it's a surviving spouse or surviving kids, they will then get the benefit of that life insurance, and it will be paid through that living trust. So that way it's going to be controlled by the successor trustee. And if there's any issues with, they need money to take care of somebody, or they need money, to buy something or pay for something or pay a tax or whatever, that money is available and you're not having to wait so long. Okay. Life insurance, and why would you not put it in there? There's lots of reasons, but if, let's say, for example, strange situation, husband and wife get into a car crash, husband dies, wife is incapacitated, and wife is the named beneficiary. So now wife just inherited, $1 million of life insurance from her spouse, but she's incapacitated and it's in her name because she was the beneficiary. Now we've got a problem to deal with. We've got to make sure there's power of attorneys and all that. So I just like life insurance to be named in the trust so that your beneficiary designation says trustee of my trust dated, all that. So if that's done with a beneficiary designation, it's your life insurance, whoever's holding it. If it's a company life insurance or private, you can do it on your own. I'll help you with this. 855-500 Trust. Coming up next, we got Rich Mathurin from GQ Law, Tax Problem Solving.
You've got questions. We've got answers. This is the Word on Wealth with Gary Quackenbush of GQ Law. Gary's here to give you peace of mind with expert estate planning, trust administration, inheritance, and probate. Call Gary to build, protect, and transfer your wealth. 855-500 Trust. GQLaw.com. online and download Gary's free ebooks and videos. Read Gary's blogs. Call or click to request your free consultation or to talk with a member of the GQ team. That's gqlaw.com. 855-500.
You're live.
Hey, welcome back to the Word on Wealth, everybody. This is Gary Quackenbush, and I have with me my associate here at GQ Law, Rich. How you doing, Rich? I'm always so glad.
Can't hear him.
I got to get you turned up here. There we go. All right.
Still can't hear him.
Why not? Because you're not talking. Okay, there we go. Hey, Rich.
Hey, Gary. Good to be here.
Welcome to the show. Sorry about that. I had Rich turned off, and there we go. So technical difficulties aside, here we go. We have a caller on the line. That's Jim Robeson. Jim, how you doing?
Good, Gary. Thanks for taking the call.
Of course.
And you've been working with me on a situation that I've emailed you about. A friend, he has a will, but he doesn't have a trust. In fact, in his will, he said that he wants to establish a testamentary trust. And I know you talked about that last week. But I'm just trying to get my hands around that, especially with the life insurance, because he and his wife do have life insurance. They have 4 minor kids. They don't have any debts, and they have some money in the bank. But if the life insurance, if the contingent beneficiaries of these policies is a person or the children, but in the will it says that they're going to establish a testamentary trust at both of their deaths, how does that work? I'm still trying to get an understanding of that.
Okay. A lot of it has to do with timing. The will will only control property or assets that are in the name of the decedent after they die. Okay. So if it's a bank account and it says, Jim Robeson on the bank account, when you die, it still says Jim Robeson. But if I look in that bank account and there's a beneficiary designation that says on my death, transfer this money to Diane, then that money is not in your estate anymore because it goes by beneficiary designation. So if you have life insurance and it says, the life insurance says, when I die, give $100,000 to Diane, then when you die, it's not in your estate anymore. I mean, it takes a little while to transfer, but legally, the moment you die, that money now belongs to Diane. Okay. So when we're trying to fund a testamentary trust, it's a little more of a challenge because the trust doesn't get created until death, but it does get created at death. So what you figure is that the estate, this trust gets created at death, and it's going to have a successor trustee and everything named. You could have the beneficiary designation of the life insurance payable to, John Brown, trustee of the Jim Robeson, trust. And because that whatever the name of the trust is that's being created in that will, because the trust is going to be created at death, the life insurance has to figure out. So you have this instantaneous beneficiary is now created because the trust is created by the will at death. That money can just go into that trust because it was created at death. So that's really the best way to do it, because if it says go to the kids, they just get the money. If it says go to, if there's no beneficiary designation, or if it says goes to my estate, then the estate exists after he dies, and that requires probate. And the probate court would simply follow the distribution of the will. And the will says, put it in my trust. And then the trust, says give it to the kids when they're 19 and 20 years old or whatever.
Right. So if it's a testamentary trust in the will and it hasn't been established until death, you would do that, or an attorney would do that, but the insurance company is going, well, tell us where the will is. Well, it hasn't been established yet. It's going to take 30, 60, 90 days. So the insurance proceeds are not going to be paid out until this testamentary trust has been established.
Yes. Yeah. And the thing, yes. So that's true, because I mean, as of the date of death, technically the will says create a trust. So legally there's work that needs to be done, and you got to get a tax ID number and stuff, but the trust exists as of the date of death. Now, my question is going to be, would a life insurance company allow you to name a beneficiary that doesn't exist yet? And I think the answer is yes, but we just don't use testamentary trust in California because of what we're talking about. It gets complicated. The insurance company says, well, it has to be a beneficiary that's alive currently. And then with a testamentary trust, if there's any property that's in the decedent's name after they die, that's going to go through the probate process to get put into this trust so that it can be given to the kids later.
Well, that's what I'm trying to understand. So if it takes 30, 60 days to establish this trust, and it's not in the trust, what does it mean it goes through probate? How long does that take? Does it cost money?
Okay. So the testamentary trust means that the trust is not created. It means that it kind of springs into life at the date of death. That's what you have a will that says all of my properties to be put into my trust. Well, the will doesn't have any property until death. So that means all the property exists after death in the estate. That property needs to go by court order to the beneficiaries. And the beneficiary named is the successor trustee of the testamentary trust that was just created. So the probate process, now with life insurance, we don't have to go through the probate process because we already have instructions that were done before he passed away that said, when I die, do this thing for me. And that's a contractual obligation the insurance company has to follow his instructions. But other things like a house or a car.
Bank account? What about a bank account?
So if the bank account is not in joint, there's no transfer on death, no pay on death, no beneficiary designation on that bank account, and it is not a joint account with somebody, then that account stays in his estate. And then that would have to go through probate, depending on the value. That would have to go through the probate process to be put into that trust. If the dollar amounts that we're talking about in the will after he dies, if his estate is worth less than $184,000, then it wouldn't go through probate. There's a very simplified process in probate. Okay.
If it's worth $500,000 in the bank account,
$180,000. So it's very small. So if it's worth
anything over $180,000 would have to go through probate.
If the estate is worth more than $184,000, the whole thing has to go through probate. So there's this thing called small estate probate, and that is if the estate is worth less than $180,400. If it's worth less than that, then it doesn't have to go through the full, year-long probate petitioning process. It just goes through a summarized, it's called a summary probate or a small estate affidavit, where we just do affidavits. So we can transfer property of less than $180,000 by affidavit, which is fast. But if it's over that, then we now run into a jurisdictional issue, which means the probate court has to be involved. And now we have the full petition process, which takes anywhere from 8 months to a year and a half on typical.
And is there a cost to that?
Yeah, probate's going to cost. Yeah, probate's really expensive. It depends on how much money is going through probate. I mean, if it's $300,000, the probate's going to cost, what's that run? $300,000 is going to run about like $10,000 in fees, and you got executor fees. So it might be $20,000 in fees and costs to get that money transferred. I know it's really expensive. So you end up looking at some really seriously expensive numbers just to do the transfer and probate.
2 minutes.
If it was
might as well have Gary establish a living trust to bypass all of that.
Yes. Yeah. In California, because of probate, I have done in 34 years, I have done one testamentary trust. That's because the client had nothing, literally nothing. He had a car and had retirement accounts with beneficiary designations. He had life insurance going to his wife and to his adult kids, and he wanted just a testamentary trust, but that was it. Other than that, because they cost just as much, same amount of money. So if testamentary trust, or a regular trust that's like a current living trust, it costs the same amount of money while you're alive. After you die, then you're going to have testamentary trust has probate fees and a living trust does not.
Wow. Okay. Well, it's either pay me now or pay me.
About a minute.
We'll pay you now.
Oh yeah. Yeah, absolutely. And the thing in paying now, it's like, it's less than you think. And you can get it done in a couple of weeks. Not a big deal. But yeah, testamentary trusts are just, I still see people, doing them, but it's because they're downloading stuff or they're trying to do it themselves. They're saying, well, I don't want a living trust because then I got to put my house in there, or I got to put my bank account in there. I need to maintain things. Well, yeah, you do, but you got to buy car insurance and got to buy life insurance. You got to put gas in the car and change the oil. Those are just kind of some maintenance things. And I don't like it, testamentary trusts because they're too expensive for what you get. And it's just not going to do what you want. And the other thing is the testamentary trust does not work during disability. If you became incapacitated and now somebody has to manage your money and all that, the testamentary trust doesn't even work until you're dead. So you don't have any of the benefits of having a living trust during incapacity. Thanks for your question, Jim. That was awesome.
All right.
Appreciate
Talk to you soon. Bye.
All right. Thanks, Jim. We'll talk to you. And we have Jim. He's our Medicare answer guy. If you have any questions on Medicare, go to MedicareAnswerGuy.com. Rich and I will be right back and talk about tax problem solving.
You don't need to know everything. You just need to know where to find answers you can trust when you need them. Welcome to the Word on Wealth with Gary Quackenbush. We're here to help you build, protect, and transfer everything you've worked hard for with expert estate planning, trust administration, inheritance, and probate. Call Gary and the team at gqlaw.com. 855-500-TRUST.
Gary, your team at GQ Law are experts at solving IRS and state tax problems. Talk about that.
When people have a tax problem, it tends to really stress them out. And one of the things we've been able to do is figure out how to resolve tax problems. One thing we might be doing is setting up a payment plan or getting a collection delay, maybe getting a determination that the person shouldn't have to pay the taxes at all. We do offers and compromise. We do audit reconsiderations. And one of the things that's a really powerful tool that some people don't recognize is sometimes bankruptcy can be used to actually eliminate taxes when there's certain conditions of the code that are met. So we can do all kinds of things after we analyze your situation. We can figure out what's available, discuss your options, and figure out which ones to implement, what it's going to cost, how long it's going to take. And we can get people out from under all kinds of tax problems so they can sleep again. That's our goal.
Request your free initial consultation. gqlaw.com. 855-500-TRUST. gqlaw.com.
Tell a friend about this broadcast outreach, The Word on Wealth, with Gary Quackenbush of GQ Law. Call or click to request your free initial consultation or to talk with a member of the team. Call Gary at 855-500-TRUST. gqlaw.com.
You're live.
Hey, welcome to Word on Wealth. We're here, Rich Mathurin from GQ Law and Gary Quackenbush from GQ Law. Today's Monday where we talk about taxes, and we've got Rich. He is our tax attorney here at GQ Law. And I got some questions for him. So I thought I would do a little interview. And this is Rich, the tax guy, and I'm going to ask him some questions. So I'm pretending like I have a tax problem. We're okay with that, Rich?
Shoot, I'm ready.
All right. Fix my tax problems, Mr. Richard. Okay. What if I don't file my tax returns for a whole bunch of years, like 5 or 6 years? I haven't filed my tax returns. I probably should, but what's going to happen to me?
There's a very real risk that the IRS and or the state of California will do what's called for the IRS, a substitute for return. For the state, it's the notice of proposed assessment, where they take any 1099 or W-2 information that they have for you, create their own tax return, give you the standard deduction, and then tax you at the highest rate available. So
they're going to do the return for me without even me giving them any information.
Yes, they do it very often. And once those substitute for returns, SFRs or notice of proposed assessment, NPAs, are put in, the taxes are usually 5, 6, 10 times as much as you would normally pay if you hired a tax preparer or an enrolled agent to prepare your returns. Also, they are not dischargeable in bankruptcy in the future. If you ever had you needed to file bankruptcy, they aren't dischargeable in a bankruptcy, even if you replace them with your own return later on. So I would highly recommend that, you engage your tax preparer to do your tax returns and make sure that you get all the deductions that you're allowed and that you're taxed at the rate that you should be taxed at. Otherwise, again, these SFRs are really insidious.
Good advice. Get your tax returns done. And you're willing to help with that, right, Rich?
We have a great enrolled agent who works with our clients to prepare a lot of missing returns from years past. He's very good at creating returns with less information than would normally be. He's very good at that. So yes, we can help you with that.
All right. And the number for that is 855-500-TRUST. Okay, here's my next one. Yeah. So the IRS is taking my bank account. They're like stealing money from me because I don't think I owe them any money. Why are they taking my bank account? I haven't even filed my tax returns in 10 years.
Again, I think this is an SFR, the substitute for return case, where they prepared returns and filed them on your behalf and assess tax balances and interest and penalties thereon. And then if you're assigned to a local revenue officer or the automated collections service for the IRS, the collection department, they can levy your bank accounts, garnish your wages.
So they don't have to go to court. They don't have to get a judge to tell them it's owed.
Yeah, that's the thing with the IRS and with the FTB. They do not need a court order to seize your property. Most a normal creditor, a credit card or whatever would have to file suit against you, get a judgment, maybe a default judgment, and then enforce that judgment. The IRS automatically gets lien rights and garnishment and levy rights with their tax assessments.
So that's why they call them the most powerful collection agency on the planet. So we shouldn't be messing with them. Okay, here's another one. Now I'm going to switch to the state of California. So the state of California Franchise Tax Board says that I owe them a lot of money. I don't really think I owe them any money. I've been making some money here and there. It hasn't been reported. I don't have a W-2 or 1099. I'm kind of a handyman guy, but the state of California, first of all, how do they even know that I made any money? It doesn't get reported.
The state of California has some very, I don't know if you call them tricky, but very creative ways of trying to estimate your income. A lot of times they will take if you have a mortgage and you get a mortgage interest statement, they'll say, how is this person paying their mortgage if they have no income? So will attribute. They usually take the total mortgage interest paid for the year and multiply it, I think, by six. And so if you paid like $50,000 in mortgage interest for a year, they'll have you say that you had an income of 300,000. So and also sometimes they'll say, well, he's working in this industry and the industry average, a person making in this industry would make this amount of money. So they will attribute that to you. Say you're a barber or whatever. They will take, whatever the average income of barbers is in state of California and attribute that income to you and do this, what we call the notice of proposed assessment, the NPA. And again, they're very, very difficult. If they put those in on you, you can't, they're going to tax you at the highest rate. And those taxes are not going to be dischargeable in bankruptcy. I have had our enrolled agent. We had a client that had a $700,000 substitute for return for the IRS for gambling winnings. Our enrolled agent went back and redid his return, and it ended up that the IRS owed him money. We had another lady recently, I think that she owed like 60,000 from notice of proposed assessments for the state, and he got her tax balance down to like 5,000. So it's again, work with your tax preparer, your enrolled agent, and get those tax returns filed, correct the NPAs and the SFRs as soon as you can, because those are very, very insidious, and they create high tax balances that you probably don't owe.
Plus, they're going to add penalties and interest. And as soon as they take your accounts, that's just horrible. I mean, you take your accounts and now your checks bounce. Now your check's going to work in the future.
It's hard to get. I can get levies released. Sometimes all of it, sometimes a portion of it. But once the IRS, the franchise tax board, has your money, they're very hesitant to give it back.
That's right. We got this. Interesting. So, and part of it, now, if you want help with this, if you have a situation, you have family members or somebody that's suffering from this, or you haven't filed tax returns in a long time, we can help with that here at GQ Law, 855-500-TRUST. So if you're looking for help, we've been doing this for a long time. We can help out. The thing with the franchise tax board, what you were just talking about, Rich, was about, you're saying that they can figure out from an industry standard. And the thing that's interesting that I learned is that you'd mentioned a barber. Well, a barber, to operate legally in the state of California, and even like, let's say in San Diego, they have to have a license. Well, guess who they have to register to get that license? State of California, right? Yeah. I mean, contractors have a California license. CPAs have a California license. We have to do a business in California, you register. And so then, and you wonder why on your tax return, they always want to know, what is your industry code? And I don't know if you noticed, but on your signature, it'll say, what's your industry code? So there's a code on your tax return that tells the franchise tax board what industry you're in. So they track and see, okay, in this industry, if somebody has a beautician's license, then they're making $85,000 a year, and they can plug that number into any beautician's tax return and claim it's the right amount of income.
Mm-hmm. And I also, another weapon that I've seen them freeze a driver's license for one of our clients. I had to work with the FTB representative to get his license unfrozen. That was
because of tax problems.
Yeah, he hadn't filed for a number of years, and they attributed a lot of income, and I think he hadn't filed for like 10, 15 years. And they froze his license. He was an elderly gentleman that was on Social Security and stuff, and he needed to be able to go to the store or whatever. And it took me a couple of months, but I did finally get it released. But that was a new one that I hadn't seen before.
Interesting. And that's the kind of stuff that starts to bug me. It's like, wait a minute, they can actually do that. Well, IRS, state, DMV, state, they shouldn't be able to connect, but they can. Well, what about if I owe money to the IRS? Can the IRS actually take my passport away?
Yes, in 2015, in the transportation law, which really you would think has nothing to do with taxes or the IRS, they wrote a thing into the bill that allowed the IRS to suspend passports for taxpayers who are seriously delinquent. I think it's $50,000 owing or more, and they can freeze your passport. And I've had probably 8 or 10 clients that have asked, "Hey, what's going on?" My wife went to go to Jamaica, and she couldn't get on the plane because they froze her passport, and it's a difficult thing once they do that.
Imagine that, though. I mean, it's bad enough to go through TSA and you go, I know I'm going to get patted down. That machine's going to buzz me. And you hand them your passport, and the person scans it and goes, sorry, you can't leave the country. You owe the IRS money. Oh my gosh, I can't imagine that.
Yeah.
But it does happen.
You need to get into a payment plan with them, do a bankruptcy, or do an offer and get an accepted offer and compromise, or they can hold your passport out. But that is a real weapon it's a new one that I don't think people really realize.
And it's almost like some of these things that we're talking about, we know this happens, we deal with this, but it's like you hear it and you go, no way. The IRS can really suspend your passport. Yes, it's absolutely true under this Transportation Act. But that's how you get laws through, right? You get some law that people like, and then you piggyback and say, well, if you guys vote for this, I'm going to put in this other one. But that was an interesting one. So and then the state of California, that's the one that surprised me, is that they take a mortgage interest statement, even if it's like, if somebody's, you're paying mortgage interest and it's, $12,000 a year. That wouldn't be a huge mortgage, but $12,000, they multiply that by 6 and they say, okay, you made $72,000 last year, single, no, no dependents, no withholding. And then they assess you this tax that you're thinking you don't even owe because you're borrowing money from your dad to whatever, but they can use those numbers and it's legitimate. I mean, it's legal. Is it fair? Nobody asked about fair. If you owe taxes, you got to deal with it. Give us a call, 855-500-TRUST. You can either talk to Rich or to me. You just call up and say, hey, I want to talk to Rich. I heard him on the Word on Wealth. I want to talk to him about a tax situation and let Rich sort it out for you. Do we need to do tax returns? Even if you haven't filed in a long time, yeah, you can get caught up. You got to have a good tax pro. GQ Law has somebody on staff that can take care of that for you. But tax problems are resolvable. It putting your head in the sand doesn't help. The IRS still keeps coming. The state of California still keeps coming. They take your money. They take your bank accounts. They take your wages. They can do all kinds of stuff. Just don't mess with it. If you got a tax problem, call 855-500-TRUST. Ask for Rich, and he'll hook you up, analyze your situation, take care of you. This is the Word on Wealth with Gary Quackenbush and Rich. Thanks, Rich.
Thanks for having me, Gary.
Appreciate it, man. All right, everybody. Talk to you tomorrow here on the Word on Wealth.
Tell a friend about the Word on Wealth, featured since 1995 with financial solutions attorney Gary Quackenbush, an expert in estate planning, wills and trusts, and tax problem solving. Gary is past president of the California Society of Tax Consultants. Reach out to us. The Word on Wealth team of financial experts is here to answer your questions and help you preserve your family's financial future.